Welcome everyone. Before we dive into today's video, I wanted to remind you that we'll be hosting a free Zoom call on the topic of changing your money mindset. If you're interested in learning more about how to shift your perspective on money and start taking control of your finances, be sure to click on the link provided. The terms bear and bull are commonly used to describe the overall actions and attitudes of the stock market or an individual asset. While they may be easy to understand, the impact that a bull or bear market can have on your portfolio and wealth is undeniable. The origin of these terms is unclear, but the most widely accepted explanation is that they are derived from the way in which each animal attacks its opponents. A bull will thrust its horns up into the air, while a bear will swoop down. These actions have been metaphorically attributed to the movement of a market. If the trend is upward, it is considered a bull market, and if the trend is downward, it is considered a bear market. A bull market, also known as a bull run, is a period of time in which the majority of investors are buying. During this time, demand for securities or assets outweighs supply, market confidence is high and prices are rising. Investors who believe that prices will continue to increase over time are referred to as bulls. The term bull market is typically used to refer to the stock market, but it can also be applied to other types of assets such as bonds, real estate, commodities and currencies. It is usually used to describe extended periods of time in which a large portion of security prices are rising. This is because prices of securities are continuously fluctuating during trading. Bear markets tend to last for months or even years. In summary, a bull market is characterized by rising prices, investor optimism, and an overall positive outlook for the market. A bear market is the opposite of a bull market and is characterized by falling prices and a general sense of pessimism. It can be difficult to predict when market trends will change, as psychological and speculative factors often play a significant role. During a bear market, investors tend to buy fewer stocks as prices decrease, leading to a decrease in demand and further drops in prices. Companies may also make fewer investments, leading to a decrease in hiring and wage increases. Unemployment rates may rise and inflation may slow down. In summary, a bear market is a period of economic decline, characterized by falling prices, investor pessimism, and a negative outlook for the market. Bull markets are characterized by a consistent upward trend in the value of assets, such as stocks, gold, and bonds. A bull market in stocks is identified by a rise in all three major stock market indexes, the S&P 500, Dow Jones Industrial Average, and the Nasdaq. These markets consistently make higher highs and higher lows, and are driven by factors such as top-line revenue, profit, and price-to-earnings ratio. Gold bull markets have traditionally occurred during bull stock markets and can be an effective hedge against other investments, providing a way to diversify a portfolio and act as a safe haven in times of economic turmoil. It is generally advised that investors allocate at least 5% of their portfolio to gold or other precious metals. Bonds have been in a bull market since the mid-1980s, where investors have not lost money when buying a bond because their rates of return have been consistently positive. A bull bond is a debt instrument with a price that is expected to increase in value if the stock market performs well. However, there is a correlation between stock and bond prices, such that when stocks go up, bonds tend to go down and vice versa. A secular bull market is a long-term trend that can last anywhere from 5 to 20 years. These markets can experience market corrections and then resume their upward swing without entering a bear market. Within a secular bull market, smaller bear markets, also known as primary market trends, may occur. One example of a bull market throughout history is the post-World War II rally, which took place from 1949 to 1956. During this period, the S&P 500 rose by 267% over 86 months, resulting in an annualized return of 20%. The main drivers of this bull market were consumer goods, as well as a strong export market that helped companies to grow. Another example is the housing boom, which occurred between 2002 and 2007. The housing bubble began after the federal government reduced interest rates in an effort to encourage investment. Financial institutions that encouraged real estate investing, home financing, and trading in mortgages performed extremely well until interest rates began to rise again and borrowers started to default, resulting in the mortgage crisis. The longest bull run in history is the record-breaking bull market that lasted from 2009 to 2020, nearly 11 years, making it the longest in history. The S&P 500 gained over 400% after a low of 666 points in March 2009. In February 2020, the Dow Jones Industrial Average reached a record high of 29,551 points. It is important to note that bull markets and bear markets are not mutually exclusive and can occur simultaneously in different sectors or markets. Additionally, it is important for investors to keep in mind that past performance does not guarantee future results and to always conduct their own research and due diligence when making investment decisions. It is also important to have a well-diversified portfolio to minimize risk and to have a proper risk management strategy in place. A bear market is a period of prolonged price declines in the market. It is characterized by widespread pessimism and negative investor sentiment, with securities falling by 20% or more from recent highs. Bear markets can sometimes lead to a recession and can last for a few months to a couple of years. However, the economy is not considered to be in a recession until the National Bureau of Economic Research determines that specific conditions have been met, such as the depth and diffusion of financial loss and the duration of the downturn. A bear market typically comes to an end when prices reach a point where they can no longer drop and investor sentiment begins to improve. Consumer and business confidence also rise and market prices begin a long climb. When stocks gain 20% from the recent low, a bull market sets in, marking a broad recovery in the market. Bear markets can be difficult to navigate, especially for inexperienced traders. It can be challenging to predict when the bear market will end and when the bottom price has been reached, as the rebounding process can be slow and influenced by a number of external factors. Bear markets may seem difficult to trade in, but they also present opportunities for investors. If your investment strategy is long-term, buying during a bear market can pay off when the cycle is reversed. Advanced investors can use strategies like short selling, which is a way of betting that an asset will decline in price. Great Depression bear market. This was the worst bear market in U.S. history and was caused by the 1929 stock market crash. It was followed by the popping of an asset bubble known as buying on margin, which allowed people to borrow money from their broker and only put down 10 to 20% of the stock value. 2008 bear market. This was the second worst bear market by percentage and was caused by the 2008 stock market crash, the failure of several financial and insurance institutions, and the reluctance of Congress to restore confidence by passing a bailout. The 2020 bear market was caused by the spread of the COVID-19 pandemic, which led to a severe recession. The market rebounded later in the year as economies began to reopen and investors regained confidence. After some time, bull markets reach a point where investors experience irrational exuberance, causing prices to escalate. Assets being traded on the market are overvalued, and investors start to anticipate falling prices. They begin to sell their investments, causing prices to fall. This loss of confidence can be caused by falling housing prices, economic circumstances, high interest rates, natural events, or anything that shatters positive sentiment. A bear market causes many investors to switch to an investing strategy of maintaining their capital instead of growing it. During a bear market, instead of investing in stocks, some might try to capitalize on assets that have had better returns. One can prepare for a bear market by reducing risk in their portfolio. You could do this by increasing the amount of cash and reducing the number of growth stocks in your portfolio. Additionally, diversifying your investments across different asset classes can help to mitigate the impact of a bear market on your portfolio. Bear markets can be a challenging time for investors, but they also present opportunities. It's important to remember that past performance is not a guarantee of future results. Having a well-constructed, long-term plan and a diversified portfolio can help you manage the ups and downs of the market and achieve sustained success. Folks, that's a wrap for today's video. We hope you found the information helpful and informative. If you did, please give it a thumbs up and consider subscribing to our channel for more financial tips and strategies.